The power of stocks and stock option. I love Forex. Forex is my baby. But stocks has a great opportunity set also. So we had to expand into the stocks and stock option. Yeah, as we on the professional side, how could we leave it out? We got to have the best of both worlds. So wherever there is opportunities, we can maximize. We have a pension plan there. We have a retirement plan there. And we have our wealth system building there. We have our cash flow there. Multiple streams of revenue coming in from all different asset class, instrument, pairs, commodities, gold, indices, stocks, across the entire board. But here's the power of options. And we want people to start tapping into the US equity stock market from right here. Generate your own US dollars, your fiat cash, your decentralized, everywhere, right? You can make your own money, generate your own money, create your own ecosystem, your own cash flow, become your own bank. Yeah, multiply your own money. But think about it. If I want to earn 500 shares, if I want to own 500 shares of a stock, so let's say stock A, and I want to own 500 shares of stock A. Now let's say this stock is trading at $40 per share. Alright, $40 per share, this stock is trading at. Alright, $40 per share. So, how much is that going to cost me? 5 fours, 20? Great. It's going to cost me 20K. Alright, $20,000 to own 500 shares of stock A. Now, this is buying the stock outright. Yeah, this is literally buying the stock. What about if I'm using options? Alright, options that has 100 shares multiplier in it. So in one call option, right, it have 100 share multiplier in it. And I have to pay a premium. Alright, so I have to pay a premium for that. So let's say I can pay $2 premium to own that one call option. So it will multiply by this 100, so that will cost me $200. So the $2 premium that I'm paying for that option, and the option already have 100 shares multiplying it. Now that $2 have to multiply by that 100, which it will now cost me $200 for that option. So if I do 5 of that now, 5 call options will allow me to have access to the same 500 shares because it have 100 in each call option. Yeah, so now that 2 multiplied by 5 is going to cost me 1,000 US. Alright, 1,000 US is going to cost me by having 5 call options. Right, 5 call options. Okay. Remember, each option have 100 shares in it. So the same 500 shares now cost me $1,000. The same 500 shares here buying the stock outright costing me $20,000. Which one would you do? Would you want to buy the options instead? Or you want to buy the 500 shares? Now, if you buy the stock itself, or you do the option, it mimics the underlying price. It derives from, that's why they call derivatives, it derives from the price of the actual stock. When the stock move $1 in price, the option move $1 in price too. Nice. Now, think about it. Why would you buy it straight outright? And this could be a very either high risk, low reward, or a low risk, low reward. Here now, we can have either a low reward, low risk, high reward. This will be more in our favor. That will limit our downside and we have much more upside potential. And here, you can have a high risk because you're exposing yourself $20,000. Nice. And then a low reward because when the market move up 41 and 42, this just moving You know, this just moving up 20,001, 20,002, 20,003, 20,004, 20,005, 20,006, like dollar value. Like based on what you put in here, your capital, it's just moving up in dollar value. Yeah? So it could be a very low risk and also low reward, according to how you structure it, or it could be a very high risk and low reward, which doesn't make sense. Yeah, and you can't take advantage of the rising and falling. You only make profit when it actually going up. So if it actually turn around, you can benefit from that if you just buy the stock outright. With a long call option, long put option, you can actually trade the market going up and trade the market coming down. So you can benefit from both sides. Here you can't benefit from both sides. You can only benefit from when the market is actually going up. Understand? So we have a low risk, high reward here, and we could actually take advantage of volatility going up, volatility coming down, the fluctuation in price. Nice. Margin, leverage, we need to actually make money. Here, 1 month to 3 months, sweet spot, 20 days to 60 days, trading volatility. Here, you're positioning yourself for long term. Time is not against you. Here, time is against you on the contract. So we buy the contract 1 month out to 3 months out, or 20 days out to 60 days out. Here, time is not against you, but you could still be down by 30-40% in the next year, and then this whole thing just worthless. Running something like this, value investing for long term, 10-15 years, it's not like back in the days of Warren Buffett. You know what I mean? It's not like back in the days of Warren Buffett. So, when you look at this, call option, have 100 share multiplier. $2 is the premium. So we pay $200 for one of the contracts. We buy 5 contracts, so it costs us $1,000. We have the same 500 shares that we're exposed to here, but we're using options here. We have a low risk, high reward formula that we get when we actually, that's why we want the options, we want the 100 multiplier. We could trade the market up, long call options, long put options. We could take advantage of rising and falling markets and still make money. Here, we could only take advantage of, if the market go up, you're making money. When it comes down, you're actually losing money. Right? We have a very high risk, low reward formula according to how you apply it, or low risk, low reward. High risk, low reward? Nah. Could blow up this whole 20,000. Low risk, low reward makes no sense. Here, and when you look at the profit margin and actually making money, when it starts to rise, it's very small. It's a very small return. It's a very low risk, low reward way to play the markets. What we want is a low risk, high reward way. So when the market starts moving from 40 and go up to 41 and go up to 42 and go up to 43 with an option, every dollar it move up, you're making money. You're making 100. Alright, so let's say it move up $1. Let's say with one call option, just to make it simple. Let's say with one call option, every time the market move up, you make 100 here. Move up again, you make 200 here. Move up again, you make 300 here. Nice. So when you look at that, it's not like in Forex where you have to go a whole 100 pips. You have to go a whole 100 pips on a 0.10 to actually make 100. By the time you move $1, you're already making 100. Forex, you have to catch 100 pips on a 0.1. Let me say to make. And that's a big move in markets according to the pace that you're trading. And gold could run to 300 pips. You can make that now for now. But on GU, EU, some of the majors, some of the minors, it have to move a good distance for you to actually catch a good $100 to make $100. Nice. So this is making much more. And if you have 5 of them, one move is $500. $2, 1,000. You don't make back all the money that you put out there already. Right? You don't make back all the money that you put out there already. Nice. 3, 1,500. 4, go up to 44, 2,000. So by the time it move from 40 to 50 or 50 to 60 within a 1 month to 3 months or 20 days to 60 days, or some catalyst come in and boom, blast it up, you can make significant money. That's why you could only invest 1,000 and end up making all kind of 60K, 100K. If you play the game right. Yeah. and you catch a really nice move, like price moving or kind of $50 in your favor, $60 in your favor, in the money, you're making joke. Yeah, so that's why I always love options over buying the stock outright. Trade options, get your US account open if your bank outside of Trinidad, get your education from Fishing for Pips. Let's go kill it in financial markets 2026. We out and bad. Catch you guys on the next one.